Hello, everyone, and welcome back to accounting. Today, we're going to talk mostly about the financial statements. But before we can do that, I need to talk a little bit about something called the closing process. Now, if you remember back to some of the early videos, I mentioned one of the assumptions of accounting is a useful time period assumption, that we can break things up into time periods, think about them in time periods. For example, if you were going to analyze a company, you wouldn't think, oh, how's the company done over its entire life? A lot of the time people ask, well, how's the company been doing this year? What if its sales this year or this quarter, etc., etc.? So part of what accounting does is after every so often, it takes some of these things that we put into the accounting equation and it closes them out. And what do I mean by close them out? Well, we take the revenues and expenses of any given time period. Normally, it's at least a quarter or sometimes a year. And then we sort of take them out of the accounting equation. And a good way to think about this would be, I can see right here, in year one, we start a company and, we don't have any beginning balance, retained earnings. And what's retained earnings? Retained earnings is saying after every so often, we're going to close out, we're going to take off the accounting equation, the revenues and expenses, and we're going to close them out into an account. And this account is called retained earnings. So, if we had, we started a company year one, we had a beginning balance of retained earnings of zero, which makes sense. We haven't had any revenues or expenses. And then in that year, we had $1,500 in revenue, cost of goods sold was $750, and rent expense was $300. Well, then our retained earnings at the end of the year would be $450. And so it's sort of like what we do is, and then next year, when we start out, we'd have a completely new accounting equation, and we wouldn't have, 1,500 in revenue, we wouldn't have 750, completely new accounting equation, except we would have, we would always keep track of and know, oh, we started with 450 retained earnings. So as you can see here in year two, we have revenue, cost of goods sold, rent expense, and a dividend. A dividend is not an expense, but it is something that reduces retained earnings. And again, that's really getting at dividends are paid to owners. A company doesn't really expense things to its owners. It's sort of just like saying, oh, this is your section of the profits, and we're giving you this section of the profit you own. So once again, add them up, we have a change of $850, but that's not our retained earnings. Retained earnings is a cumulative account, which means it's always taking into account all of the past transactions. So we have an $850 increase, but we started with $450, which means at the end of year two, we have $1,300 in retained earnings. So again, it's sort of a way of simplifying, or I set up here compiling the information, some of the information. So we take these revenues and expenses, close them into an account called retained earnings. And of course, dividends, even though it's not an expense, it's a distribution of earnings. So that's saying, hey, we had this distribution, we have these earnings, we're distributing 200 of them. And normally that's done in like a cash dividend, or, there's actually more types of dividends. But for right now, we'll just assume that the basic transaction is giving cash dividend. So I just wanted to let you know before we go into, I'm calling them, so you can see down here, accounting products, which are the financial statements. So that's pretty much the layout I've been giving you so far. So you have this accounting equation. You're putting in all these entries I've been showing you, and then the only thing that I didn't show you that I just showed you today is at the end of some time period. And companies can decide how often they do this. Some companies may do it month by month. You can do it quarter by quarter, 3 months, or you could just do it yearly. Public companies need to at least do it quarterly. Normally quarterly is when they put out little mini financial statements compared to the big year-end financial statements. So again, this is how it all connects. with accounting, when a company enters into a transaction, some type of transaction we can actually record, we put it in the accounting equation, and then at the end of the year or period, it could be any set of time, doesn't have to be a year, we close out revenues, expenses, and dividends and retained earnings, and then we sort of have this jumble of stuff. We have these assets and liabilities on our books. The revenues and expenses and dividends went into something called retained earnings. So, and again, so all of this happened, and if an investor says, "Oh, I want to know how the company is doing," are they going to want to look through all of these, hundreds and thousands, sometimes hundreds of thousands or millions of transactions the company has? Are they going to want to go through some thousands of page accounting equation workbook? No. What an investors and business owners and government entities do is they say, well, we're going to give you a format for taking these aspects of the accounting equation, summing them up together, and then making these statements, which are, again, the best way to sort of think about them is, a statement is taking pieces of parts of the accounting equation, summing them up, and putting them in some sort of format, like a template, to convey this information the accounting equation has in an easy, or at least hopefully easy, to understand. So again, I said show year to year. That's like at least, that's like the minimum. You have to show it at least year to year, but companies can do that. And again, so we're doing this for useful information, which means these have certain qualities. So the first quality is you want them to be comparative. This is what I probably meant by show year to year, is if you have a financial statement for a company, it's no good to just know this financial statement. I mean, it might be sort of interesting maybe, but you'll want to have some type of comparison, because that's what these financial statements are for comparison. For the same company, how it's doing period to period, have sales grown or something like that? Has expenses grown? Has assets grown year to year? And another thing is you want them to be comparative between company and company. So that's the whole investor's dilemma. We're going to look at maybe Apple and we'll look at Google, and then we have so much money to invest. Where do we invest it? Well, we'll look at their financial statements and the information conveyed there. And again, that's the whole point of accounting, is that we're going to take all these business transactions, sum them up in an accounting equation, and then take that accounting equation and put pieces of that accounting equation into different formats that we call financial statements. And again, for those to be useful, they need to have the same accounting method, or at least similar accounting methods, or if you change them, or if you have, you had a choice and you chose one way or the other, you're going to talk about that and you're going to make notes. And that's something I want to bring up right now. Notes to financial statements are just as important as the financial statements themselves. So far we've gone over very basic accounting. I haven't really given any, you could do this way or that way, but just to give you an idea of what's going to come up. A lot of the time in accounting, you have many different options of how you're going to record something in the accounting equation. Methods, and sometimes you change methods, and companies don't always do the same accounting rules, or they follow the same rules, but they're given options. So, again, for comparability, when they make these financial statements, they'll make notes that go along with them and say, this is how we constructed the financial statements, and this is what's going on, and here's some interesting information that you should probably know. So again, along with these financial statements, you're going to have notes. And again, the whole reason we're doing this, the whole reason of accounting, is to put these actions into an accounting equation, and to put this accounting equation into financial statements, and to somehow, whether it be through note disclosures or just general rules, make these financial statements comparable enough year to year within the same company and between companies, so investors and government regulators can do all this and they can make informed decisions. So, I've been using financial statements very vaguely. I haven't told you what the financial statements are. So now this next little section, I'm going to go into them. I'll get to this note later. So basically, the accounting equation is broken down. One, into a balance sheet. And I guess a lot of good ways to think about this is through the balance sheet. Essentially, the accounting equation is the balance sheet. So whenever you were looking at the whole total assets, total liabilities, total equity, all up to this point in time, that's the balance sheet. And actually, I'm going to take you to a real-life balance sheet. So instead of showing you some sort of simple, watered-down version, which, we'll get into those simple versions later, but I sort of want to show you just a real-life example. So to find a company's actual financial statements, go to sec.gov, the Securities and Exchange Commission, and then this little link right here, company filings, and then every company that's publicly traded has a ticker symbol. So for Google, it's GOOG. And then I'm going to go to their annual report, which is also called a 10K. Documents, go right here. And this is Google's 10K, and as you can see, there's nice little notes right here. Item 8, financial statements and supplementary data. And here you can see these are the financial statements. Balance sheet, income statement. Now this statement of comprehensive income is more like a part of the income statement. So there's 4 main financial statements. There's the balance sheet, the income statement, statement of shareholders' equity, and the statement of cash flows. 4 statements all stem from the accounting equation, but are sort of different ways of presenting the data and different ways of doing it. So first we're going to go to the balance sheet. And as you can see here, the balance sheet is really just the accounting equation summed together. So you see assets, total assets, and liabilities and equity. And what do you know? The total liabilities and equity, 110,920, is equal to the total assets, 110,920. And you can see here that they broke this down. This is called a classified balance sheet, which means instead of showing all of the, like take for example, cash and cash equivalents. I don't worry about the term cash equivalent right now, but just say this is cash. So instead of just showing, here's the thousands of pages of accounting equation worksheets, they went through and they looked at all of the cash transactions, summed them together, and this is the cash we have in 2013, sorry. And as you can see here, this is comparability. 2013 and 2014. There is more. There's slightly less cash and cash equivalents as of the end of the year 2014. And, marketable securities, then they give subtotals. This is called a classified balance sheet. So a non-classified balance sheet would just be saying, this is total assets, this is total liabilities, this is total equity. Just showing you those 3 basic accounts. But a classified balance sheet breaks them down into these sub-accounts. And most companies, do classified balance sheets. So as you can see right here, and they break them into current and non-current in the balance sheet. So a current means that it either is cash or will be turned into cash in a year or operating cycle. Now a year, that's obvious, 365 days. Operating cycle is a little bit more ambiguous. What an operating cycle is however long it takes to have a product, sell a product, and get the cash for it. That process of getting the product, selling it, and getting the cash for it. That's considered an operating cycle. So for example, if if Walmart buys a toy for 10 cents. They place an order for a toy for 10 cents. A week later, it gets delivered there. A week later, it's sold. And then a week later, they get the cash for it. That's a 3-week operating cycle. So the rule is current is defined as if it can be turned into cash in 1 year or one operating cycle, whatever longer. Now, as you can see from my example I gave you, operating cycles tend to be decently short. They don't tend to be 1 year. So most of the time, current assets mean it's being turned into cash within a year because the year is normally longer. But there's exceptions to that. Take, for example, Boeing. They make huge airliners. It can take them a really long time to build a plane, a really long time to sell a plane, and definitely a really long time to receive the cash for it because they're huge, clunky, expensive purchases. So Boeing's operating cycle may be longer than a year, meaning some of these, if we were looking at say Boeing's balance sheet, it may be turned into cash and may take longer than a year, but anyway, that's the whole thing with current versus non-current, if it can be turned into cash. And then a balance sheet is, because of that rule, turned into cash is current. These are an order of liquidity. A liquidity is just a vocabulary word which means how quickly it can be turned into cash. So you see here the first item, cash equivalents, it is cash, it's already cash. And then marketable securities, that means it can be very quickly turned into cash, still less than a year. And then they give you a subtotal. That's another aspect of a classified balance sheet. They're always giving you subtotals. Then you have accounts receivable. And don't worry about this net of allowance. We'll get into that later. So that's saying that accounts receivable can be turned into cash quicker than deferred income taxes, but not as quick as marketable securities on average. So again, it's an order of liquidity. So this is, and then you see here current liabilities, accounts payable, short-term debt. These should be some terms you're familiar with. Some of these terms you won't be. A deferred revenue really just means, again, deferral. That's the same as unearned revenue. And some of these you'll see you haven't seen yet. And that's okay. Some of this stuff you may not see until intermediate accounting or even advanced accounting. So I just wanted to show you real life examples just so I'm not pulling numbers and ideas out of nowhere. And also I think it's really important for you to start seeing actual real life financial statements and how to get them and the process. So next you have statements, the income statement. You start off with revenue minus expenses. First, you have operating expenses, which are expenses that you can directly tie in to the basic operations of the business. And it's selling and administrative. And then you have income from operations. That's a really important, again, a lot of this is subtotals. The subtotal for total costs and expenses. So revenues minus the total cost is going to be income from operations. And then you can see right here below that, interest and other income. Net. It just means... but anyway, so interest and other income, they're not in the business. Google's not in the business of making loans, but sometimes they get interest income and other income. Sometimes they can have gains and losses on items, and what a gain or a loss is compared to income. We'll get into later. Pretty much what it means is that you bought and sold something at some type of gain. So if you bought it for $100 and then you sold it for $120, but it's not inventory, you're not in the business of buying and selling it, we'll call that a gain. And we'll separate it from operating income, which makes sense because, hey, if you just happen to get lucky with buying and selling equipment and you have a gain, that gain shouldn't be in your operating income. You're not in the business of buying and selling equipment. Google is in the business of primarily ad revenue. So, that's the importance of, these income statements. And it's a way of looking at, okay, how much are they making from their core business? How many gains and losses are they just getting from other aspects that aren't their core business? How much are they paying for taxes? You can see right down here, net income is the bottom line, profit essentially. Net income is profit. And then this section right down here, diluted, blah, blah, blah. This is really just getting at something a little bit more complicated that we won't be getting into right away in accounting. Earnings per share, which is just saying if you take the number of common shares outstanding, how many shares are not, not in the company's hands, but in consumers' hands. They buy stock in the company. How much income is attributable to each share? And there's basic and diluted, which is a more complicated process. We'll get into that later on, maybe even wait until intermediate accounting to get to that. But just know basically, you have net income, and then you take net income divided by the common shares outstanding, which is just another way of saying how many shares are available on some type of stock market or in non-company hands, because sometimes companies buy their own shares of stock, in which case that's not considered outstanding. But I'm getting into a topic that, again, we'll get into later. Right now I just want to show you, okay, an income statement has revenues and expenses directly tied to the operating of a business, and that, again, that changes business to business. And then they'll put, other gains and losses and other income, and then, some type of, tax expense, and then this discontinued operations, that don't worry about that right now. Pretty much if Google decides, or any company decides we're not going to continue with this business anymore, they'll take it out of their operating or other section, just because, hey, it used to be our core business, or it used to be something we did, but now we're not doing it anymore. And then you end up with net income. And then, this comprehensive income, don't worry about this just right yet. This is something that's really for intermediate or advanced accounting. I wouldn't worry about it just yet. Just hold tight on that. And then you have statement of shareholders' equity. That's just saying, hey, that assets equal liability and equity. We're going to make a statement that just looks at equity section, just looks at the equity section. And this is pretty much showing you a way to think about this. This is showing you the closing out of net income and equity. See, you're starting with retained earnings. This is a little bit of a wonky one, but you're starting with retained earnings. And don't worry about this other comprehensive income. And then you're adding net income, and that gives you, the ending balance of retained earnings. Oh, well, that gives you, this intermediate number. And then, if you had dividends, you pay out dividends. And then, bam, this is the retained earnings. Again, don't worry about this other comprehensive income. We'll get into that later. And then you have the statement of cash flows. Now, the statement of cash flows can be a really complicated statement. At the very beginning, when we're talking about making the statement of cash flows, we're going to deal with simple examples. We're going to deal with simple companies. And what we're going to do when we're first talking about the statement of cash flows is we're literally going to look at our small, tiny accounting equation. And we're going, like maybe only a page or two. And we're just going to count up how much cash we have. And that's how we're going to figure out cash at the beginning. Now, by the end of this tutorial, this whole tutorial series, I'll talk to you about how companies in the real world figure out, cash flows, which is a little bit different. But all I want you to understand right now is the statement of cash flows is just showing you what's the actual cash paid, and received as well. Because again, remember, we're accrual accounting, which means we don't care about cash when we're figuring out revenues and expenses and things like that. But it's still really important to keep track of how much cash we have. So, it's really important to keep track of how much cash we have. So that's why I make the statement of cash flows. So, and the basic format of the statement of cash flows is you split them into three different types of activities. There's operating, investing, and financing activities. Operating activities means that it deals with the direct operations, main purpose, core activities of the business. So with Google, Google is in the business of pretty much, ads. That's where they get most of their revenue from. So operating is going to be things like, cash received from ads. It's going to be things like cash paid to employees because, employees day-to-day operation. Again, don't worry about this stuff. This is something we'll get to later. But just operating cash flows or things like revenues and expenses paid for the core business and paying employees and things like that. Now, what does investing activity mean? Investing can mean two things, okay? Two basic things. Investing can either mean A, you're actually putting money into a different company. Like, let's say that you're Google, but you buy some of Yahoo's stock. That's considered an investing activity. But that's not the main thing normally what we're talking about with investing activity, because investing activities can also be seen as purchasing equipment. You see first line item right here, purchasing equipment. That's a really important aspect. So if you're a company and you buy some long-term piece of equipment, that's considered investing. If you buy a building or land, that's considered investing. Not inventory. Inventory deals with operating, because that's something we're actually buying and selling and getting revenues of our core business from. But from investing activities, that's a huge deal. That's equipment, buildings, land. If you buy some type of, permanent structure kind of deal. Or if you buy into an actual other company. And financing activities are just ways that your company gets money. So cash inflows and outflows from financing activities, which are pretty much issuing stocks, paying dividends, and then issuing and paying bonds. So, if we issue a bond and we get money and we have to pay it back, essentially taking out any form of a loan, that's a financing activity. Now, the generally accepted accounting principles, US GAAP, is a little bit weird in that the money we receive for a loan and the money we pay back for the principal on that loan is a financing activity. But the interest expense is considered operating. That's a weird little rule. The idea behind that is that interest expense accrues and happens in a time period very akin to, an operating cycle, I guess you could say. Or, just sort of like it accrues and happens and you're paying out interest expense, sort of the same way you would pay out any other type of expense that you use for operating a business. That's not the case with international accounting. Again, the United States is a little bit different. The U.S. uses U.S. generally accepted accounting principles, and a lot of other countries in the world use what's called the International Accounting Standards Board, International Financial Reporting Standards. Sort of how the United States has the English system and the rest of the world uses the metric system. It's sort of similar with accounting, except unlike the U.S. and the metric system, accounting rules and standards tend to be pretty similar, but there are some differences. But for the United States, we put paying interest in the operating, and that's just sort of a weird little rule. Again, there's the justification of it looks very similar to any type of other expense, but I don't know, it's a little bit weird to me. But anyway, so financing activities, paying principals on loans, or issuing stock and paying dividends. Those are financing activities. And then, as I said earlier, sometimes just as important as the actual statement themselves are the notes to the financial statements. Now, in Intro to Accounting, we don't really go too heavy into notes and what's in the notes and everything like that. That's something for intermediate and advanced and just figuring it out in actual practice. But also know, and we'll talk a little bit about the notes as we go on later on, but remember, these notes pretty much are a way to sum up really specific, important information. And also, when we get farther into accounting and we start talking about, like, whoa, these are more complicated transactions, we have a couple different options on how to record this transaction. Well, whatever way we chose to record, that'll appear in these notes somewhere. But anyway, back to my little Excel spreadsheet. You can see what I'm talking about. See, this is the accounting equation. Cash assets and non-cash assets. I broke assets up into cash and non-cash. But assets equal liabilities plus owner's equity. And which is contributed capital and then retained earnings. So owner's equity can be contributed capital, or owner's equity can be from retained earnings. As you can see here, this whole entire thing is the balance sheet. The whole entire thing is the balance sheet. If we were to look at just cash, that'd be the statement of cash flows. If we were to look at entirety of shareholders' equity, that would be both owner's equity from contributed capital and retained earnings. And then if we were to just look at revenues and expenses, which are closed out in retained earnings, that would be the income statement. And again, you can see right down here, the little weird thing, dividends do not count as expenses. Again, that makes sense because you don't expense something to your owners. You just redistribute your earnings to the owners. You don't expense them. And again, I have right here, go to sec.gov, look at some real financial statements. And again, the huge note, cash flows are split into operating, investing, and financing, and inflows and outflows. And this little note right here, we didn't see it. Maybe I just grazed over it. Don't worry about that right just yet. And pretty much the idea is that if you have a significant non-cash transactions, sometimes we'll put it as a note to the statement of cash flows. Like if we traded $100 worth of tractors for $100 worth of wheat with another company, that wasn't a transaction that involved cash, but it was sort of similar to it. And we did it based on how much cash stuff is worth. So barter system almost. But don't worry about that. That's more of like a complicated topic that I just wanted to expose you to the idea. But sometimes statement of cash flows, it's primarily only about cash, but sometimes in the notes we'll talk about other exchanges that don't involve cash. But again, that's just the notes. The actual statement itself, only cash items, only cash inflows and outflows. And as you can see here, this XBRL controversy, just so you know, what companies can do is right now they're trying to make it easier for investors to receive information they're looking for from the financial statements and give investors more opportunities to look at, what's specifically this type of revenue or this type of, whatever. And pretty much the community, accounting community and government community and business community, it has come up with almost like a software system called XBRL, Extensive Business Reporting Language. That has a huge controversy to it because it's not highly regulated. I just wanted to let you know it's out there. A lot of the time, accounting textbooks talk about it. All you need to know about this is that, hey, this XBRL is essentially a software computer coding system that puts all the aspects of the financial statements into sort of like a program that you can, if you know the coding, more readily look up information. But don't worry about it. We're not going to ever use this in this tutorial session. And then, I made a little note what auditors do. Auditors look over the financial statements and make sure they were done properly. I won't get into the controversy of auditing just right yet. This is already turning out to be a long video, so I'll get into it later. But like all of accounting, I can explain these terms to you. I can, say, the accounting equation, here's the different aspects and here's the different financial statements. But I think the best way we learn is by example. So, here I sort of have This is sort of like old examples and everything like that, and getting at the accounting equation. But first, I want to go over an example with like maybe statement of cash flows. Again, all these statements are important. Normally, what companies can do is they'll first do the income statement, because then with the income statement, you know what net income is, and then you can do the balance sheet, because then you can update. Well, maybe they do the income statement. Really, companies can do their own method, and they have it. But you know, when we're doing this in accounting, maybe the income statement would be really good to do first, because then you know net income. Then maybe the statement of cash flows, so you know your changes in cash. Then you can do a balance sheet, because hey, we know, or the statement of changes in shareholders' equity, because if you know net income, then you can know old retained earnings and what you paid for dividends. You can know ending retained earnings, and then you can flow in like a lot of the other aspects into a balance sheet. But all the statements are important. Pretty much do them in whatever order you can. And don't worry, I'll get into examples. But I just wanted to, stop, pause, and go over a little bit of what we learned. So in the statement of cash flows, let's say these are all cash transactions. Is it operating, investing, or financing? So you buy equipment. What is it? It's investing. Because, again, it's sort of like you're investing in your own company in a way. You're buying this equipment. We have it. We're building a better business. You pay a salary. What's that? Operating. Again, cash paid to employees. It's, it's actually part of the core business is we have to pay employees to do work so we can run this business. That's operating. You receive a loan. Well, that's financing. Bam, bam. You buy stock of another company. Investing, that makes sense, investing in another company. Receiving a loan, that's financing. You pay an electric bill with cash. What's that? Operating. And getting paid for goods sold, again, operating. That's revenue almost. In cash, of course. All these transactions are in cash. So bam, And then I'm already sort of a little bit worried that this video is going a little bit long. So what I'm going to do is I'm going to pause it here, and then next time we meet, we're going to do a comprehensive example of everything we learned. From transactions, just being told transactions, into putting them into an accounting equation, and then we're going to make the financial statements based off of what we have in our accounting equation. So again, I hope that, as with all of these videos, I threw a lot of information at you. Don't worry if it's all jumbling around right now. We're going to give you a lot of examples on how to do this, and throughout the rest of the time here, we're going to continually go back. And again, a huge part is understanding this graph right here, how we take information from the accounting equation and we put them into these own statements. And again, I think sort of the best way you can learn sometimes is by example. So here's sort of a preview of what we're going to do, and next time we meet, we're going to do a comprehensive example. Here's how you put these things in the accounting equation, and here's how we make income statements, all the financial statements based off of them. So, in the meantime, study hard, and I'll see you then.